Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of anything I buy.
For years, Warren Buffett has consistently seized golden opportunities from market downturns and panic selling, turning declining stock prices into massive gains. But as anticipation builds for yet another lucrative opportunity in 2024, birthed from the embers of uncertainty, Buffett's message is clear. The chance to strike it rich is on the horizon, and those who miss out on it stand to lose big. In today's video, we'll be talking about the key indicators to suggest why this is expected to happen, its implications for you, and what you need to understand. We'll also discuss how you can prepare and take advantage of this crazy opportunity to build wealth and stay ahead of everyone else. So, remember how 2023 kind of broke our hearts? Between March 2022 and January 2024, the Federal Reserve increased interest rates a total of 11 times, making the cost of borrowing expensive and life more unbearable for lots of people. But amidst the optimism that things will get better this year, what if we told you that 2024 could actually get worse? This year, the economy will face three really big issues: high inflation, expected higher interest rates, and growing national debt. These problems affect different areas, including real estate and how much companies borrow, and this will have astronomical effects on everyone. To start with, the government will have to pay more interest on its debt, which of course means that taxpayers might also have to up their ante. But hey, remember when experts and various reports were all predicting that millions of people would lose their jobs in 2024? Well, it's already happening. American employers cut more than 84,000 jobs in February, the largest figure of any February since 2009. So, this all seems like pretty bad news, right? But here's the thing. Contrary to what common logic might make us believe, the life and principles of Warren Buffett tell us that all in the face of gray financial clouds, there's always a rain of opportunity. But if you want to seize that opportunity, you'll have to understand one thing: PSDO. Never heard of it before? It's an acronym for Panic Sale Discount Opportunity. And what it tells us is that panic leads to mindless sales, which then provide discount opportunities for smart investors, and thus mega profits. Remember when Warren Buffett said this about America's economy?
Fall of 2009, and it continues to improve. So I just don't see it. I've seen the February figures for our companies, and
Many laughed at him when he made this bold statement, but as time has proven again and again, he was right all along. America has its history of staggering lows, but like clockwork, that economy bounces back in rapid time due to its resilience. And the people who benefit from that resilience are the people who think like Warren Buffett, the people who understand PSDO. These are the people who win in the economy.
the extreme rich are clearly winning. The very rich have done exceptionally well.
Allow us to walk you through a practical example of what this panic sale discount opportunity means. So back in 2020, when the COVID pandemic took over China, it spread to the US and other parts of the world. With all that craziness happening in the markets, where things were going down at record speeds, basically everyone was panicking about what would happen to their investments. Many even predicted that the market would crash so hard to the point where it'd never recover. But what happened next? We all survived, didn't we? Now, for the older viewers who were around and investment smart to an extent in the 2008-2012 real estate cycle, you will agree with us when we say that the real estate market was hit pretty badly and prices were at all-time lows. In the fourth quarter of 2008, the median existing home price in the US saw a significant drop, falling by a record 12.4% compared to the same period in 2007. This marked the largest quarterly decline since NAR started tracking prices in 1979. Looking at the entire year of 2008, NAR reported a substantial 9.5% decrease in the median existing home price, down to $197,100 from $217,900 in 2007. Now walk with us here. Imagine how panic and pandemonium filled the air in the tumultuous era of the 2008 real estate crisis. With people rushing to offload their properties, fearing the worst for the housing market, Peter, a random guy who understood Warren Buffett's philosophy and PSDO, saw opportunity where others saw chaos. While friends and experts cautioned against investing in real estate during such uncertain times, Peter had a different vision. Despite warnings from experts and friends, Peter bought a discounted house in the belief that the market would eventually rebound. And that it did, because as the years rolled by and the dust settled from the crisis, Peter's once cheap house transformed into a hit. Property values soared, and his insane gamble eventually paid off. In the end, Peter's story serves as a stark reminder of the Oracle of Omaha's strong love for when the market prices come crashing down.
Anytime stocks go down, as far as I'm concerned, I like it because I'm a net buyer of stocks. I've been buying stocks ever since I was 11 years old. So when stocks go down, it's good news. Just like when hamburgers go down, it's good news, or Coca-Cola goes down, it's good news in terms of.
Guys, the greatest rewards sometimes come from going against popular belief, trusting your instincts, and daring to defy the odds. We guess that's why Warren Buffett once said, "Beware the investment activity that produces applause. The great moves are usually greeted by yawns." Permission to blow your minds away, but did you know that millennials and Gen Xers have seen 3 once-in-a-lifetime golden opportunities in one lifetime? Taking a stroll down memory lane to the start of the millennium, the dot-com bubble was growing from strength to strength. Everyone seemed to lose their minds regarding companies with the word "com" at the end of it, and these firms gained millions of dollars from pretty much every investment institution on Wall Street. With valuations skyrocketing, no one stopped to think, hold up, is this actually sustainable? It's hard to blame them though. Markets were rising, people were making money, investors were happy, bankers were making money, everything was good. But of course, when the bubble eventually burst, it didn't care about anyone's feelings. People flipped out, with many strongly believing that no one would ever use the internet again. But now you can see that emotions like excitement or panic can actually make people make poor investment decisions. Why do you think Warren Buffett once said that the biggest mistake people make when investing is listening to others? Only when your mind is grounded and you filter out all the noise from the public will you be able to win. So where are we going with this? First off, you have got to understand that when it comes to the market, panic begets opportunity. But if you want to seize that opportunity, you need to be able to understand PSDOs. And of course, you've got to be prepared. For nearly a century, the U.S. economy has witnessed a recession almost every decade. Surprisingly, the longest period without a recession followed the 2008 crash. Then the pandemic hit, resulting in a mandated economic shutdown and what some have described as the most severe recession since the Great Depression. However, it presents opportunities. Whenever you encounter adversity, you also encounter the potential for growth. But just like we said earlier, these opportunities are accessible solely to individuals who, again, understand the philosophy of panic sales discount opportunities, and secondly, are well prepared. Make no mistake, if you begin to establish financial readiness during stable periods, particularly by bolstering your bank account, you'll be presented with the chance to capitalize on golden opportunities during the inevitable and challenging times. But in case you're wondering when exactly 2024 is going to nosedive for most Americans, the truth of the matter is that we genuinely have no idea. We can't predict the future, but we can see some pretty red flags worth calling out. At the moment, the cost of living is above what the average person can afford with his income. And if it wasn't already a big problem, the higher interest rates also pose a big threat as we basically now have more debt than ever before. Currently, we're facing unprecedented levels of credit card debt, with corporations and commercial real estate landlords also grappling with record high debt burdens. This situation coincides with a noticeable shift in commercial real estate landscape, as many office spaces remain partially vacant. Consequently, if landlords are forced to renegotiate their debt at significantly higher interest rates, they'll be contending with increased costs amidst reduced income. We're also seeing changes in the economic shift. The Federal Reserve has openly stated the necessity for the rise of unemployment to help alleviate inflationary pressures and temper economic activity. The logic of this is pretty simple. If an additional million or two people become unemployed, the newly jobless and their families would likely reduce spending significantly. Meanwhile, for those who remained employed, wage growth would likely stagnate. The idea is that when companies perceive that labor costs are unlikely to increase, they'll refrain from raising prices. So you see, it's all a part of the master plan. They want to mitigate inflationary pressures by slowing down the rate of price increases. While the exact timing of this economic deceleration remains uncertain, warning signs are evident, and historical patterns indicate its inevitability. Economic slowdowns have occurred regularly throughout the past century, making it unrealistic to believe that they won't happen again. So it's basically a fundamental part of our economic system that we must acknowledge and duly prepare for. Now this leads us to the million-dollar question. How can we prepare for this? Preparing for a market crash can be quite tricky, but if there's one thing that Warren Buffett has taught us, it's that investing can be pretty easy. Here's a simple 4-step strategy to follow when facing a market crash, starting with step 1. Understand what assets you own and the reasons behind holding them. Guys, there's a big reason why Warren Buffett said this. A fear-driven reaction to a temporary slump isn't a good reason to dump an investment. Understanding your investments is paramount during times of market turbulence. It provides the foundation for informed decision-making and risk management. When you have a deep comprehension of the businesses and assets in your portfolio, you can assess their risk levels accurately and diversify effectively to mitigate potential losses. This knowledge also enables you to maintain a long-term perspective, focusing on the underlying fundamentals rather than being swayed by short-term market fluctuations. Step 2, however, is pretty straightforward, and it's all about trusting in diversification. You see, market downturns come with a lot of risks, especially when investing in the stock market, and that's exactly why, when it comes to mitigating risk and preserving capital during market crashes, you're not going to get any better deal than diversification. Trusting in diversification means recognizing that no investment is immune to market volatility. While some assets may perform poorly during a crash, others may hold steady or even appreciate in value. By diversifying your portfolio, you increase the likelihood of weathering market downturns with minimal damage because spreading your investments across different asset classes and industries provides you with the opportunity to reduce the impact of any single investment's poor performance on your overall portfolio. Now, step 3 is one of our favorites because it kind of underscores Warren Buffett's belief that every investor should be happy when the prices of stocks go down. The simple truth is that it's the bear market that makes people rich. If you want to take advantage of market crashes, you've simply got to buy the dip. Think of it as buying stocks on sale when the market crashes. As investors, we should always be ready and willing to spend money on investments whose prices are dropping. Remember the real estate example we gave earlier concerning Peter? You have to repeat it. But first, here's how to know when you're ready to buy the dip. You have an established emergency fund. You've allocated funds for retirement. You have enough cash for daily expenses. Additionally, having reserve cash for opportune moments and maintaining a wish list of stocks you're interested in can indicate readiness to capitalize on market downturns. That said, it's pretty unlikely that you'll hit the market's absolute low. But that's okay. The essence of value investing lies in seizing opportunities where you believe investments are undervalued and possess strong long-term potential, regardless of pinpointing the market's lowest point. However, a strategy to alleviate concerns about bad timing is to employ dollar cost averaging when investing. This method spreads out your purchase of assets over time, helping you to smooth out the overall purchase price. It allows you to invest consistently, even when other investors may be hesitant or sell off their investments. And finally, step number 4 comes from an evergreen, iconic quote from Warren Buffett that says, "If you aren't willing to own a stock for 10 years, don't even think about owning it for 10 minutes." During a stock market's downturn, it's natural to feel uneasy witnessing your portfolio's value decrease. However, if you're investing with a long-term perspective, maintaining composure and refraining from immediate action is your best bet. After all, if selling your investments during a downturn only solidifies your losses, why bother? For instance, during the February 2020 market crash triggered by COVID-19, an ETF tracking the S&P 500 could have plummeted by over 30%. Had you sold your investment, you would have realized those losses. Yet by holding onto it, you could have potentially recouped your losses by August of the same year. So you see, thinking long-term during turbulent market periods is a key strategy that can never go out of style.